7 Secret Investing Rules, Hedge Funds Exposed to Rich Interns. A friend who interned at Bridgewater leaked me the exact playbook they give trust fund kids on day one. And when I read it, I genuinely got angry. Because rule number 4 alone would have saved me $11,000 in my early 20s. These are not the generic diversify your portfolio tips you hear from every finance bro on the internet. These are the actual frameworks that families worth $50 million drill into their children before they even get their first job. And here's what really got me. The reason most of us stay broke isn't because we lack discipline or intelligence. It's because no one ever handed us this playbook. Until now. So my buddy Marcus spent last summer at Bridgewater Associates. That's Ray Dalio's $100 billion hedge fund. On his literal first day, they sat the interns down in this windowless conference room. No phones allowed. And a senior partner spent 3 hours walking them through what he called the real rules of wealth. Not theory, not textbook stuff. The actual mental frameworks that separate people who retire at 45 from people who work until they physically cannot. Marcus took notes on paper because, again, no phones. And when he showed me those notes over drinks last month, I made him photograph every single page. I'm about to walk you through all 7 rules, but I need to warn you, Rule 6 is going to contradict almost everything you've been told about investing. And Rule 3? That one made me completely restructure how I think about my 20s. Let's get into it. The first rule in the playbook was written in all caps at the top of the page. Your salary is a distraction. Now that sounds insane coming from a place where first-year analysts make $200,000. But here's what they meant. The partner told these interns a story about 2 Harvard graduates from the class of 2008. Both got jobs paying $85,000 their first year out of school. By 2023, one of them was worth $4.2 million. The other was worth about $180,000. Same starting salary, same education, same job market. The difference? Graduate A treated his salary as seed capital. Every year, he lived on 60% of his take-home pay and invested 40% into 3 specific asset classes. Graduate B treated his salary as lifestyle fuel. Every raise meant a nicer apartment, a better car, a more expensive vacation. The partner then said something that stuck with me. He said wealthy families teach their kids that a salary is a tool, not a reward. You're not being paid because you deserve nice things. You're being paid because someone is exchanging money for your time. And your job is to convert that money into assets before lifestyle inflation eats it alive. The specific framework they teach is this. Live on your age minus 10 as a percentage of your income until you hit your first $500,000 in invested assets. So if you're 25, you live on 15% of your income. If you're 30, you live on 20%. I know that sounds extreme, but remember, these are the rules for people trying to build generational wealth, not just survive. Now, the second rule connects directly to this, and honestly, this one made me rethink my entire investment strategy. Rule 2 in the playbook was labeled the 72-hour wealth test. And this might be the most practical thing I've ever learned about money. Here's how it works. Before any purchase over $200, wealthy families force a 72-hour waiting period. But not just to sleep on it. During those 72 hours, you calculate what they call the true cost. The true cost isn't the sticker price. It's the sticker price multiplied by the growth you would have earned if you'd invested that money instead. They use a multiplier of 88. That sounds random until you realize it represents what $1 becomes over 40 years at a 12% average return in the S&P 500. So that $300 jacket you want? The true cost is $26,400. That $50,000 car upgrade? True cost is $4.4 million. Now here's where it gets interesting. This isn't about never buying anything, it's about buying with full information. The partner told the interns that rich families still buy expensive things. They just never do it accidentally. They make the purchase knowing exactly what they're trading. A trust fund kid I know uses an app that automatically calculates this for every transaction on his credit card. Every single purchase shows him the true cost next to the actual price. He told me it completely rewired his brain in about 6 weeks. He went from spending about $4,800 a month to around $2,100 without feeling deprived at all. Because when you see that Uber Eats order isn't $45, but actually $3,960 in future wealth, you start cooking at home real quick. Rule 3 is where I had to put the notes down and just sit with it for a minute. They call it the allocation irrelevance window. Basically, the playbook states that until you have $100,000 invested, your asset allocation is almost meaningless. This goes against everything personal finance content tells you. You always hear about the perfect portfolio split, which stocks to pick: international versus domestic, growth versus value. But here's the math they showed the interns. If you have $5,000 invested and you beat the market by an incredible 10% in 1 year, you've made an extra $500. But if you increase your income by $8,000 through a side project and invest 40% of that, you've added $3,200 to your portfolio. 500 versus 3,200. Below $100,000, skill at investing is almost irrelevant compared to skill at earning. This is why trust fund kids are taught to spend their 20s maximizing income, not optimizing portfolios. The playbook specifically says, and I'm quoting from Marcus's notes here, below $100,000, every hour spent analyzing investments should instead be spent acquiring income-generating skills. They listed specific skills that have the highest income potential per hour learned. AI tools, sales, copywriting, video editing, financial modeling. Speaking of AI tools, I've been creating content almost twice as fast since I started using 11 Labs for voice generation and research synthesis. That's at try 11 Labs. O2PU109Y92JL1. If you want to check it out. But honestly, the bigger point here is that wealthy families push their kids toward tools that multiply output, not toward picking better stocks. If you want more of this, hit subscribe. I drop one of these every single day. Now, Rule 4 is where I lost $11,000 by not knowing it earlier. They call it the liquidity ladder. Most people our age keep money in one of two places: a checking account earning 0.01% or investments they cannot touch without penalties. The playbook says wealthy families teach a 3-tier system. Tier 1 is 1 month of expenses in checking. That's it. No more. Tier 2 is 6 months of expenses in a high-yield savings account earning 4 to 5% right now. Tier 3 is everything else in investments. But here's the key. Those investments are structured so you can access 20% within 48 hours without selling at a loss. This is done through a margin loan against your brokerage account. I didn't know this existed until I was 26. I had to sell $11,000 worth of stocks at a loss during a market dip because I needed emergency cash. If I'd had a margin facility set up, I could have borrowed against those stocks, waited for recovery, and never realized the loss. Setting this up takes about 15 minutes on most major brokerages. You don't have to use it. But having it there means you never panic sell again. Rule 5 is the one most videos will never tell you, because it sounds irresponsible. The playbook calls it strategic debt arbitrage. Wealthy families don't avoid debt. They weaponize it. Here's the framework. If you can borrow money at 6% and invest it at an average return of 11%, you're making 5% on money that isn't even yours. This is literally how private equity works. This is how real estate empires are built. But here's what they're not telling you to do. They're not saying put everything on a credit card and gamble it. The specific rule is this. Debt is acceptable only when 3 conditions are met. 1. The interest rate is below your expected investment return. 2. The payments are below 15% of your monthly income. 3. The debt is attached to an appreciating asset, not a depreciating one. So a 6.5% loan to max out your Roth IRA when you're 23? That might actually make mathematical sense when you model it out over 40 years. But a 6.5% loan to buy a car? That violates condition 3. Cars depreciate. Wealthy families play this game constantly. They borrow against real estate to buy more real estate. They borrow against portfolios to fund businesses. They use debt as a lever, while the rest of us treat it as a trap. The difference is understanding the rules. Remember when I said Rule 6 would contradict everything you've heard? Here it is. Ignore compound interest until you're 40. Wait, what? Isn't compound interest the whole point? Here's what they actually mean. The compound interest charts everyone shows you are calculated over 40-year periods. But when you're 24, obsessing over compound interest can make you too conservative too early. Wealthy families teach their kids to take asymmetric bets in their 20s. They say use 15% of your portfolio for high-risk, high-reward investments. Angel investing in startups. Concentrated positions in high-growth stocks. Speculative assets with huge upside. The math works like this. If you lose that 15%, you have time to recover. If you 10x it, you've just compressed a decade of compound growth into 2 years. This is why PayPal gave early employees stock options. This is why wealthy families let their kids invest in their friends' startups. Your 20s are the only time in your life when you can afford to be strategically aggressive. And Rule 7? It ties this all together. Network worth over net worth. The playbook emphasizes that below